Okay, I've had enough. I'm tired of all these overcomplicated YouTube videos that are trying to explain the 2008 financial crash like you're trying to study for a PhD. So I decided to make a video where I'm gonna break it down simply. No jargon, no fluff, just clear, easy to understand facts. Now, imagine there's a house. Let's say this house is worth $1 million. Now meet John, a regular guy looking to buy that house. Normally, someone like John would pay part of the house's price up front using their own savings, and for the rest, they'd get a loan from the bank. Let's say John has saved $200,000, and that's his down payment. For the remaining $800,000, John applies for a loan. But here's the thing, banks don't just hand over that money because John asked nicely. He has to prove that he's responsible enough to pay it back. So, John shows the bank his paperwork, proof of his stable job, consistent income, and a clear financial history. Since John's been working hard for over 20 years, the bank feels confident he can pay off the loan. In a normal world, this is a pretty stable system. If the value of John's house goes up, great. John's investment is worth more, and the bank feels safer about getting their money back. Even if the house value drops a little, John's stable job still means he can make his monthly payments and the bank still gets paid. No problems here, everything's fine. Now, here's where things start getting a little weird. In the early 2000s, home prices in the US had been rising for years. This led people, including banks and buyers, to believe that home prices would never fail. This belief changed everything. Remember how the bank only gave John an 80% loan to protect himself in case prices drop? Well, if home prices never go down, why stop at 80%? If the bank gave John a 100% loan, or even more than the house is worth, they'd earn more money from interest. And from John's point of view, if his house is just going to keep increasing in value, why bother putting down his own money at all? Just borrow everything and let the rising house price do the work. Free money, right? Well, not exactly. By now, banks were so confident that prices couldn't fall that they started handing out loans like candy at a parade. Suddenly, they weren't just giving out 100% loans, they were offering 115 and even 125% loans. That's right, banks were giving out more money than the house was worth. And if that sounds reckless, it gets worse. The banks started giving these massive loans to anybody. No job, no assets, no problem. As long as they had a pulse, they could get a loan. The logic was simple. If these people can't pay us back, they can just sell the house for a profit. No big deal. Meanwhile, people like John started buying multiple houses. 1 house, 2 houses, even 10 houses. After all, if you're told you can make free money without risking your own cash, why stop at one? Now, enter the investment banks. The big players who found a way to turn this whole situation into one giant casino. Here's how their game worked. Banks would take mortgage loans, like John's $800,000 loan, and package them together into a product called a mortgage-backed security. Then, investment banks would turn to investors, which would be big companies, rich individuals, and you name it, and say, hey, want a piece of this loan? Buy it, and you'll earn interest just like the bank does. It was sold as a safe investment. After all, house prices never go down, right? But the game didn't stop there. When those high-risk loans, the ones handed out to people with no jobs or stable income, weren't attracting enough investors, the bank got creative. They mixed bad loans with good loans in one big package, slapping a shiny, safe investment label on it, and convinced investors that this mess was still secure. It's like blending expired milk with fresh milk and saying, don't worry, it's drinkable. For a while, it worked. House prices kept climbing and everyone was making money. But like a bubble, things couldn't keep inflating forever. 2006, the US housing market started to cool off. Suddenly, those risky homeowners, the ones with 100% and 110% loans, started to fall behind on their payments. First, the low-income buyers defaulted, then the buyers with 90% loans, then those with 80% loans, and before long, it all came crashing down like a row of dominoes. Those investors who had bought into the safe mortgage packages, they started losing huge amounts of money as those bad loans turned worthless. To investment banks, who had stacked their fortune on these loans, started collapsing too. Then came the commercial banks, the ones handling regular people's savings and mortgages, and they began folding as well. It didn't take long before the entire financial system was in a free fall and the stock market crashing right along with it. Of course, the government stepped in to stabilize the situation by injecting money into the economy through quantitative easing, essentially printing money to keep things from spiraling even further. But by then, the damage was done. Jobs were lost, homes were foreclosed, and the world was plunged into one of the worst economical downturns in modern history. The 2008 financial crash wasn't just bad loans. It was about greed, reckless decisions, and the dangerous belief that this time will be different. So the next time someone tries to tell you there's an investment that's too good to fail, just remember what happened when the whole world believed that housing prices could only go up. Because no matter how good the hand looks, the house always wins. If you liked today's video, please consider subscribing and liking the video. Thanks for watching.